All right, welcome to episode 2 of Breaking Ground. I'm Steve Kliegerman. I'm joined today by my partner in crime, Robin Schneiderman, Senior Vice President of Business Development at Brown Harris Stevens Development Marketing, and Noah Rosenblatt and John Walkup from UrbanDigs. Thanks for joining us today, guys. Really appreciate you coming on.
Our pleasure.
So, as the year starts out, before we start talking about 2024, let's talk a little bit about 2023. I know you guys really focus a lot more on the resale market. Robin and I focus a lot more on the new development market. But I see those two markets informing each other. So what are your takeaways from 23 as we lead into 24?
Yeah, well, first off, thanks for having us. I'm glad 2023 is over. Let's just say that. I mean, from a volume perspective, it was a low transactional environment. I think 23 was an extension of what started in mid-22 when the Fed started hiking rates. And I think although rates peaked in 23 and actually came down towards the end of 23, it really was an extension of that slow cycle that started in the second half of 2022. So 23 was really marked, in my opinion, by low transaction volume, a very challenging listing environment for sellers. It was for the most part, a declining price action market. I mean, I think right now, as we speak today in January, I think prices are down about 10%. Compared to maybe this time last year. All of this with less inventory, less supply, less new listings coming on the market. So the one saving grace that you can think about is this tight inventory market. And we can go into why that's happening and some of the forces out there. But I think the tight supply has, in some way, shape, or form, maybe muted the depth of this downturn that we had, or might contribute to the recovery when or if that comes.
Oh, interesting.
Yeah, no, I think you're exactly right. The only thing I would add is that what made 2023 special as a down market was it was down on the supply side, it was down on the buy side, and it was not a consumer-driven decline. Nothing was wrong with the consumer. Value stayed up, and maybe they've gone down 10% or so, but it's not like you see in 2008 when the financial system came to a pause and just everything was just falling left and right. No, just the market sort of deflated. But this was much more of the professionals took the hit, not the consumer. The consumers were happy to not do anything and you notice that because no one listed on the buy side, no one was buying on the buy side. Everyone's looking at rates thinking, whatever, I'll do something else with my money this year. So as we enter 2024, that's sort of the lesson I take away is that everything that was happening was not really a problem on the consumer side. It was much more of a problematic a problematic market on the professional side.
That's interesting. So what you're saying is it really impacted the real estate industry more than it affected the public.
Exactly right.
Right, and that makes a lot of sense.
Some areas housing didn't even decline, or is just only starting now to decline. A lot of areas, even outside of Manhattan, has the same tight inventory, and I think John's right. I mean, people are frozen, right? Consumers are frozen, sellers are frozen. There's a financial disincentive to sell. There's a financial penalty to sell. If you do sell, you're going into a market where there's nothing for sale. And from a buy-side perspective, even if rates did come down, they may be like, I can't find a place that really meets my needs or makes me want to pull the trigger. They're frozen. So all of us are waiting for what is the macro element or what's going to change out there that's going to unlock both supply and demand. And
there's also a lot of buyers that have their low-rate mortgages that they're locked in for years. So it's really hard for somebody that has in some cases even sub 3% mortgage to sell and then buy into a 6% mortgage environment. So
unless they have to, right?
Correct. I think that's one of the critical reasons why absorption was down, 35% or so year over year, right? It's hard to sell out of that and buy into that and feel good about it, even though you can refinance. And I think that's what a lot of our real estate professionals are talking about today is rates are starting to finally trend down, right? So even if you were to buy today, I think we're down. 90 bips is what I heard today on the yield. You can eventually 12 months from now, or even 24 months from now, probably refinance into a 5% rate environment. So I think buyers will start to, engage with that.
Right.
So,
sorry.
No, go
so
ahead.
you touched on something very interesting there, and one of the pieces of research we've done is we've looked at contract signs versus mortgage rates and tried to get a sense of what really is the correlation. It doesn't really exist. It's very weak. Is there one? Yes. Is it the main driver? No. I think what you hit on is the trend in rates. And as rates are rising, I think people back off because it's a sense of uncertainty about what the future is going to bring. And as rates start going down, all right, well, you got a little bit of a sense, but you're moving. You want rates to kind of go sideways for a while. You want people to get some visibility into what 6 months is going to be, a year is going to be, a couple years going to be. Like, all right, it's going to be 6%, and it looks like 6%. Fine, I'll act on that. But if you look at it and it's like 6%, but if I wait 9 months, maybe it's going to be 3%. You're probably going to want to wait. If you're at 6% and you think it's going to be 8% coming up, it's like, who wants this? I'll just keep renting. So that, I think, is going to be the key this year, is hopefully getting a sense of stability and continuity in those rates.
Yeah, absolutely. So stability, so people feel confident in the market in general, but now may be a good time to buy with prices down a little bit, and then but you're buying into that stability.
Correct.
I mean, I think it's a great time to buy. Here's the data behind why it's a good time to buy, because and we put out a sell call in May. So it's not like it's time to buy. We put out a sell call saying, sell, get out. The reason it's a good time to buy now is because this has been a long duration down cycle. We are in the exhaustion phase right now. And if you're a seller out there, it's been low volume for 18 out of the last 20 months. And it took us a good 16, 18 months to get to this moment in time. And you have prices down 10%. You got a challenging listing environment for sellers. You got low volume. And what's about to happen in the next 60 days? Our spring active season. And if we see volume even come back to normal levels, forget about high levels. If we just come back to normal with tight supply, you are going to see all those leverage, all those market advantages that took 16, 18 months for buyers to develop in this moment in time, it'll evaporate. It'll fade. And that's the reason why we think the buy side window is in the process of closing over the next 30 days. And on the flip side of that, the sell side window is going to start to open as we get into March and April. Interesting.
So Robin, we talked a couple of minutes ago about supply. On the development side, supply is pretty constrained as well. What are you seeing there, and is there a path to more supply in the future?
Yeah, I mean, we track this stuff on a daily basis, and currently, as it relates to new development inventory in Manhattan, we have about somewhere between 400 and 4,500 units left to sell. And what I mean by that is listings that are either actively on the market or in what we call shadow, is units that exist but aren't officially on the market. In 2023, we sold approximately 1,500 new development units in Manhattan. And then the year before that, we had a banner year, right, coming out of COVID, where we sold actually over 2,000 units. But typically, on average, if you just look at the past 4 years, we're about 1,500 units per year. So you just do simple math, right? That's about 3 years of supply, which in Steve and I's viewpoint is a healthy new development market. The biggest takeaway that I see is there's 5 buildings in Manhattan that comprise of 35% of the existing 4,500 units. So if you just take those 5 buildings out of the equation for a minute, which is 1 Wall Street, it's the leftover inventory at 1 Manhattan Square, it's the 1 High Line, Lend-Lease's project up in Morningside Heights, and the West on 47th and 11th. Those 5 buildings, the Waldorf, so it's 6, comprise of basically a complete year or even more of inventory. If then we take the 3,000 number, in our viewpoint, the market is actually really, really starting to feel tight. And I think that's going to help people make decisions if they want to purchase new development. But the issue, as we're talking about here today, is inventory. There's just not a lot of options out there. And when you guys walk around the city, do you see a lot of cranes in the air? I certainly don't.
No. Well, on 2nd Avenue, I do. Up in Yorkville, there's a few cranes, but it's not a lot. It's not like Brooklyn.
No, and 3 or 4 of those are rentals.
Correct.
Right.
Correct.
Yeah.
The Upper East Side is probably the only sub-market neighborhood that has a vibrant pipeline. But throughout the rest of the city, it's really tight. And New York, a residential building in New York City typically takes 3 years to build.
And that's what I was going to say, is that the seeds of this has been sown years ago. And that's the thing, is what could potentially change today? Even if something changed today, you're not going to see it for 3-4 years.
That's right. And that's why, we talked last episode, we talked with Bob Knackel about office to resi conversions, and we're all very focused on office to resi conversions. But even if we, started working on those tomorrow, they're 3 years away. So that's inventory that's not hitting the market for 3 to 4 years.
Yeah, and if you think back in the last 4 or 5 years, there's really even since 2018, 2019, 2020, with the pandemic hitting, it's like I feel like a lot of development decisions were just put on hold, right? And I haven't looked at permits or applications. I don't know if that's starting to rise or not, but I imagine if it is starting to rise, it's ticking up off a bottom, and it's not really rising in any meaningful way. So to me, I think this is going to be a tight inventory market for a period of time. And if you recall, 2013. 14
Very similar.
and 15,
Yeah.
right? It was even like 2005, 6 into 7 also. I feel like there's a lot of similarities going on there.
Yeah.
And that's the thing. If demand does come back, right, will we have those decisions being made? Will that come 3 years later? Is the resale market going to go bring thousands
Right.
of units back on?
Right. And the other thing is, you were talking earlier about you feel that at least on the resale side, the market has corrected about 10%. But if you think about that, 10% off of a banner year in 22, where there was 18 months of pent-up demand, people started returning to Manhattan, and we had change in rent laws in 2019 that basically took a tremendous amount of potential inventory for conversions off the market, for residential conversions. Plus, now, good cause eviction, no one's moving, right? So you have less vacancies in rentals. Every new rental building that's coming to the market in Manhattan is going to be averaging over $100 a square foot from what those developers are telling us. So that should push people back to the buy side again as well.
I think it will. I think it will. I think it's going to surprise you. I mean, it's just a matter of what triggers it. Is it going to be seasonality? Is it going to be a macro thing? I have no idea. I don't know. I don't know if it's going to be rates. I don't think rates are going to go down that much this year. I think buyers think rates are going to get cut a lot. And I think the Feds, I look at the inflationary elements. I look at the unemployment market. If they cut rates now, stock market at all-time high, unemployment really, really low, that's not really an environment to cut rates significantly. John made an argument that they could cut rates just a couple of times to normalize it, but not to cut it in reaction to an economic slowdown.
Correct.
And what's amazing is we looked at all of our transactions within our portfolio and new development wide. It was something like over 75% of all new development transactions in Manhattan paid cash.
Incredible.
Right? So what does that say?
A lot of liquidity out there.
There's a tremendous amount of money that's floating around that can buy if they want to, but for whatever reason they're holding back because of rates, or they think the market's going to go lower.
Well, they think, because they think that rates are going to push the market lower, and it's really not happening because of all the cash buyers and the lack of supply. So you talked about you don't know what's going to be kind of the genesis for that. So I know you work with a lot of brokers. You provide analysis and analytics to a lot of brokers. Can the brokerage community help with the supply and demand issue by messaging? Can the brokerage community do a better job of getting the word out there about what the real inside deal is about the residential market, and not just what you read in the papers?
I think so. I think it comes down to reflecting what's actually happening on the streets in your messaging. I think that messaging that comes out that sort of romanticizes what you want to have happen, which is like, oh, I need more sellers, so I got to talk about, hey, it's a great time to sell, or I want to get some buyers, so it's a great time to buy, even though it might not match what's happening. I don't think that's in anyone's interest. But I think if you're honest and you approach it from, hey, I'm an expert in this, here's what's happening, I think you can find some resonance, and you can say, listen, this is a good time to buy, and here's the reasons. And if people don't want to buy, they see your evidence. All right, at least I see what you're saying. It makes sense, but it's not the right time for me. And so I think that can kind of help shape the narrative, at least kind of clear away the clutter for folks to say, all right, well, this is a market I want to move forward in.
Yeah, it's a great question, and I'll say some agents do it much better than others. Messaging is really hard. Really, really hard. John and I are terrible at it. Like just to be full disclosure.
Well, you guys have been around 14 years, so you're doing something right.
We're good at reading the data and telling what's going on, but we're very bad at messaging. You know what I'm saying? But messaging is real. Some agents are really good at it, and they're very good at taking data and turning it into a digestible, understandable, resonating sentence. And some agents don't know how to do that. And I think, I'll tell you, from a buy side or a sell side perspective, I think there is a hunger. I think there is a craving for independent, unbiased market expertise. At the end of the day, all these guys want is to work with a professional who knows their job, and can service them when they need to buy or sell. So, having that image as an expert helps with the messaging, But a lot of agents really, even the best ones, it's one of those things where you could always improve your messaging. It's like it's a never-ending thing. of how improvement you can do on messaging.
Yeah, absolutely. And it's amazing because, ultimately they are salespeople,
Yep.
right? So they should be messaging better, and hopefully you guys can help them continue to do that. Even if you're not good at it, or you don't think you're good at it on your own, I know you help a lot of brokers figure out their messaging, and also help them figure out how to really take a look at the numbers and not just see through the numbers, frankly, right? And find those data points that make sense.
You just have to explain what type of market environment the buyer or the seller is about to go into. It's very they don't know. They want to know. It's cloudy. They're flying an airplane with no instrumentation in a cloudy storm, and it's hard to make a decision when you don't have that clarity or that transparency. So by providing this information, you're just giving them their altimeter back. You're giving them their speed back. You're giving them now they can make a decision, and that's what it's all about.
Yeah, absolutely. So, Robin, you analyze a tremendous amount of new development data, right? And I think in this past year, we've really taken a little bit different approach also to how we're micro-analyzing the data when it comes to supply, demand, number of units that were absorbed within a certain amount of period. How do you see that helping us shift this narrative going into 24, both with developers, but also getting that word out to buyers?
Right. I mean, first of all, what I found interesting is we typically focus on the last, call it 24 months, to try and get a sense of where the market is, and in some cases as short as 6 months. But what I found is recently we're actually going back to the last cycle. Earlier you talked about 2013, 2014, and there were a lot of developments that were tremendous success stories, right, in 12, 13, and 14. And what we're noticing is those projects that succeeded, the pricing that they achieved is actually consistent with some of the projects that were sold out in the last 24 months. So our approach really, as you talk about how to articulate data and really peel back the onion and get to a conclusion, that's really the power of us in trying to advise our clients. But it's interesting to see how the cycles have shifted so dramatically.
Yeah. So the cost of new construction, the cost of development hasn't gone down, right? Maybe the cost of acquisition, right? Maybe the cost of acquisition has gone down a little bit, but the cost of construction, obviously the cost of financing has gone up. So your prediction for the future is prices go up, even though in the resale side prices are down a little bit.
Yeah, I mean, I know last week or month you had Bob Knackle on, and Bob, I'm sure, told you, land pricing has adjusted, but not significantly, right? It's come down a little bit. I mean, from the all-time highs when, the one Highline site, I think, sold for almost $1,000 a foot. But the most recent trades in 2023 were somewhere in, call it the $400 to $500 a square foot, and some even $550 a foot range. So until prices come down further as it relates to land, I don't think you're going to see a dramatic shift in price appreciation, but I certainly don't think it's going down.
Yeah, and it's also, you think about new development, right? I mean, you take out those 6 buildings like you mentioned earlier, and you have 1,000 units less, or 1/3 of the supply out of there. Yeah. So, I mean, it's a very erratic, volatile set, and you're going to be really looking at what types of buildings closed and what periods of time. It's probably going to be heavy with some buildings versus others. So it's a really difficult market to just put everything in one bucket and look at as a blanket statement type of thing because of all the different buildings and all the different locations. And
then the other market that we haven't discussed is Brooklyn. I mean, Brooklyn went through a rapid transformation over the last decade, right? There was tremendous development. And we were talking about the supply and demand in new development. I honestly don't know what it is for resale, but there's something like 2,000 units left to sell in Brooklyn new development. And in Brooklyn, they sell about somewhere around 1,000 units a year. So it's even less than 2 years of inventory. Yeah. And there's a couple buildings that have probably 20% of that inventory. So Brooklyn's actually even in greater need for new construction than Manhattan. Yeah. And the pricing that prime Brooklyn has been able to achieve is now north of $2,000 a square foot, which is higher in some cases than some neighborhoods in Manhattan.
Yeah,
right? Yeah. So it'll be interesting to see. We have a bunch of rentals that are going to come online in 24 into 25. Everybody is, anxiously awaiting the rise of Gowanus, right? 6,000 apartments are going to come to one, sub-market. It feels like, Williamsburg 2.0. But it should be exciting to see how all of that get absorbed. I know, Steve and I talked to a lot of those sponsors. They're projecting $80 to $90 per square foot in rents, which is big numbers. So hopefully something's going to happen in our government, and we can get some kind of new tax abatement to get more rental development coming. I don't see it happening for condos, but until the new 421A or what I heard the new one's
425, whatever,
285X
right? Whatever
into
Hochul
play.
calls it.
I think we're most likely, we'll see some condos continue to trickle onto the market, but you will not see any rental development until that happens.
Yeah, well, it would seem to me that means that there's an opportunity for development in other boroughs as well. Whether it be Queens or the Bronx. Everyone talks about Mott Haven, and we've seen a tremendous amount of rentals come up in Mott Haven. I'm starting to hear about condos coming to Mott Haven, but it would seem that if Brooklyn is going to be eclipsing the $2,000 a square foot range, and Manhattan has a low inventory, but prices aren't going to go down, prices are going to stabilize or go up, then there may be opportunities in the future for expansion into the Bronx, into Queens, right? And that may be actually an opportunity for the brokerage houses as well, who, 15, 20 years ago, everyone all of a sudden realized that Brooklyn was a marketplace, and all of a sudden every large, firm, hung a shingle in Brooklyn. I think that same thing will happen in Queens. Actually, I don't know how much you guys look at Queens, but I see that happening, and I already see the Queens market changing. Astoria has gone through tremendous changes. Obviously, Long Island City, which not everyone even considers Queens. It's kind of like its own submarket of Queens, but I think there's opportunity there.
Yeah, we haven't gotten the data yet in Queens. We've been stuck with Manhattan and Brooklyn, but we're looking to expand as soon as
I think that's a good place to expand to. So you guys have now been doing this for 14 years, actually a little bit longer, but 14 years as UrbanDigs, right? How have you seen the market evolve? How have you seen analysis evolve? I mean, obviously technology has evolved a lot. How has that impacted your business and just overall? If you look back 14 years and look at today, what are the commonalities? What are the differences?
Well, it's funny because so much changes, but so much still stays the same. So getting the data was in the beginning very difficult. You got to get it. You got to clean it. Now it's a little bit easier now to get that data, and we have more pieces that we can assemble. But at the same time, things like Schedule A's for new developments, right? What does that inventory look like behind the scenes? That has always been a potential area of just frustration for us, because unless we went out and got the Schedule A's and put it in, it was always like a mismatch. So finally, Revenue's doing something about that. You got to put the Schedule A in when you put the listing in. So there is some
Thanks
change.
to who?
Yes.
Thank you, Steve.
Thanks to me and Steve Goldschmidt and my new development committee. Yes, we have finally brought ourselves into maybe the 19th century.
Right. Right.
Well, one day we'll get to 21.
Yes, it turns like a battleship that's been frozen in ice, but the wheels are turning. So there is, we have seen some changes, but again, I mean, you think about the markets, right? And there's only 9 markets you can have. You can have the sell side. Markets are either up, flat, or down. And you have a sell side and you have a buy side. That's 3 times 3. That's 9. And we've been doing this for 14 years. We've seen all 9. We've seen it when both are up, both are down. One's flat, one's up, the other's down. We've seen all of these things. So the messaging, I know, and Noah was mentioning how messaging is tough. Having been in business for this long, we've seen these markets. We can understand how the messaging in 2012 is echoing what's happening right now. We can see how the messaging from 2020, when the market was frozen, was echoing that of 2008. So there's a lot of similarities in terms of what the markets are doing and what that message is. So even though the numbers are different, the message is the same.
Yeah. Way back then, there was no data to make messages. Way back then, I started. I'm almost getting into my 20th. But it was the New York Times ad section.
That's right.
It wasn't even. It was whether or not you put an advertisement was the inventory level for Manhattan. I mean, no charts. We had no CMA tools, comps tools. It's come a long way. Technology has come a long way. The weapons that to better serve the customer, make the customer more in a more transparent vision has come a long way.
It has. to go in Manhattan. I mean, compared to that have multiple listing services where
share data with each other.
Thank you.
Crazy.
I completely agree. And now going into the Rebney RLS, big help.
Yes.
Our next development committee will be, talking, getting, full information in. The Schedule A is going in as a PDF into a database, although you can certainly enter it into your. The next step should be transparency in data. Your opinion, the keepers of data and analysts of data is that the more available, the better it is, versus our colleagues feel like if they withhold data, it actually creates this mystique in the market.
Yeah, I mean, as a whole, that does. Maybe one person. It helps the and because they want to protect this information because it gives them a competitive edge.
But it doesn't help them because they're going to get a lower price.
At the end of the day, it's self-serving. At the end of the day, it's not serving the customer or the client. It's serving the professional at the end of the day, and that's kind of a disservice.
Yeah.
I mean, but again, you think about where we came from. Data wants to be free and available, right? And you got a consumer that has to make a decision. And a seller needs to know where to price. They need to know when to do a price cut. A buyer needs to know if now's a good time to buy. What is this place worth? If the data is available to both buyer and seller and the broker, it should be a more efficient market.
Absolutely.
If both buyer and seller see where the information is, they should be okay going there. They should be okay going there. And that's all we want is to have a transparent, efficient marketplace. That makes quicker decisions.
Yeah, absolutely.
A lot of people put decisions on hold if they don't have the information. So that's not what professional brokers should want.
Yeah. Yeah. I mean, Robin and I drive ourselves crazy all the time because a lot of developers, until these changes at the RLS, were withholding contracts signed. And then all of a sudden, Robin, you'd have 50 contracts signed hit in a building in one day, and that just skews all the data.
Yeah.
Tell us about it.
There you go.
Correct. I mean, also rental data would be.
Rental data.
That is.
I mean, talk about it's a very
tremendous mountain we got to climb with that one.
It's a very fast-moving data set. I mean, if you think about data from a quality point of view, you got to think of its completeness, its depth, its reliability, its timeliness. You know what I'm saying? And when I look at the rental data, there's XXXX on all of those types of things. That's a good explanation there. So there's some mystery in the rental market that maybe there doesn't have to be. But there is. And until that changes, until we get the information, I mean, the data is only as good as that agent putting it in the system. So you do need that governing body to come on here and make sure those that are in violation or not updating correctly change their behavior. It's tough.
Yeah, absolutely. Well, so the takeaway for me is inventory is low, which makes it hard to make decisions for buyers and sellers. There's not a whole lot of inventory coming down the market, but if we had better transparency, more transparency in data, that might actually help the brokers with their messaging.
It could help. It could help. I don't know if it's going to change the market. I am a believer. I don't know what your thoughts are on this, but I'm a believer that the market does what the market wants when the market wants to do it, and none of us is bigger than the market. There was a time a couple of years ago where we put out a piece saying like sell, the market's going down a little bit, and we expect a good buying opportunity in the future. And we got some really negative feedback, like you guys are making the market go down with press like this. And I'm like, if you believe that we really control,
I'm that powerful.
Yes, I mean that's lovely, thank you. But it's just completely couldn't be further from the truth. Nobody's bigger than the market.
But they never thank us when we push the market up.
They never thank. Yeah, they don't talk about it that way.
See, I don't think you can change the market, but I think you can change a mind. And I think that getting out there with good, accurate, just market reporting and opinions, like voice your opinions in a neutral, transparent way, I think you can change someone's mind. I think you can get someone off the fence who may be considering making a move. And so you may not move the market, but you can certainly change your mind.
You can change a perception.
Yeah.
Absolutely. Well, this has been great, guys. I can't believe it's almost been 30 minutes already. Noah, John, partner Robin, thank you guys very much. This has been terrific. We're going to have you guys back in a couple of months. We're going to see how our predictions are. We'll find out where the market has gone. And we certainly next time we're going to talk some music.
That sounds great.
All right. Thank you.
Have
guys.
a grateful day.
Thanks, guys.
Have a grateful day.